Hello, Oracles. Welcome to Friday Night Live with Oracle here. So we're going to discuss earnings we got going on. Earnings season has kicked off. Give you guys a few minutes to jump on here. Get things straightened out. So I'm a little crooked here. Got some camera issues. And yeah, so we got earnings season kicking off. We had banks this week, and banks didn't give us any major indication of problems. So while I'm not ready to jump all in right now because of what the banks have told us, it is a nice little sign showing this because the way I look at it is back in 2007, right around the same time, banks were giving us the thumbs up as well. So not to say that it's going to repeat itself, but just kind of giving myself a little pause and saying, good sign. Let's see how much further this can go and make sure that we can get through all this. Sorry. Some technical difficulties. I think we're good now. All right. So yeah, so again, earnings kicked off, like I said, with the banks. Big tech kicked off technically with Netflix yesterday. Next week we've got Tesla coming out with big tech, and then the week after that is the next, basically 2 weeks after that are just all the monsters are coming out. So earnings season is going, and so far it's going all right. Oil prices continue to come down, and we're looking at oil earnings are going to be coming up in 2 weeks. So I do own ExxonMobil and Occidental. So those are the two oil stocks that I own. I own Hess Midstream as a midstream gas play as well, just for some energy there. But yeah, Occidental and ExxonMobil, again, based, man, see, these are the technical difficulties I'm having, and I don't know why. I think it's the updates that Apple has sent out on their the new software updates for Apple, which are always awesome. And I knew I should have waited and not updated mine, but I think it did it automatically. All right, let's see how much further we can go before I have to do that again. So yeah, so like I said, the oil stocks are coming out, and now historically, when we're looking at things, market pulling back, getting into a recession, oil prices spiking have been a big cause of that. And oil prices coming down is a great sign. My only concern for this is if oil prices are coming down, a lot of people, and they've been down for a while, they've been coming down, they've been staying down. Again, awesome for the consumer, awesome for prices of everything out there. But what's going to end up happening is everybody will get used to that. And then oil prices don't have to spike as high as they have before into the 90s to cause a massive shock. They might just have to jump up to the 80s to cause a bigger shock. And so that's just kind of one of the things that I'm really paying attention to when it comes to oil prices. The conflict we've got going on in the Middle East right now, obviously things are going on over there. Important people are getting taken out. But is that just going to cause more tensions? I don't know. Again, history just needs to play itself out for us to see. But it's just one of those things that I've got in my mind, just reminding me of these are things that are going on and potentials. And there's always those black swan events. Now, of course, we had 2 years of basically a dozen black swan events. Haven't really had any over the last year. So, little things here and there, but nothing major. Thinking back, basically it was the end of October of 2023. Since then, we've been pretty much straight up in the stock market. It's almost unrealistic, but that's where we've been at. And historically we've seen times like this. So it's not like this is completely unusual, but it's one of those things that gives me a pause of, haven't had any black swan events, great, but also haven't had those healthy pullbacks. And pullbacks are healthy. Just like relating it to health and fitness, taking a rest day is important. Taking that time to let your body recover gives you an opportunity to get better foundation and grounding to push yourself forward even stronger. The market needs the same thing. We really haven't had much of that this year. So again, not saying that the market is due to pull back because it's due to pull back. I'm just saying that it's a good thing if it does. And I just want to be ready for it when it does. And getting into my portfolio, I'll jump into that with you guys. Let me jump it up here for you. And next weekend, I will have my end of the month review of my October for all of my portfolio. Let's see, get this up for you here. And so I did a bunch of adding this week, and I'll show you guys here. So with my portfolio, for you guys who don't know, my portfolio is basically set up different phases and levels. So I'm at phase 1, level 9, and What that means is each one of these sections has a certain criteria and level I want to get every stock and ETF to. So everything in the green here, I want to get to $1,400. And those are my higher yield plays. These here are just my long ETFs that I'm holding. I want to get those to 1,200. My dividend growth stocks, I want to get to 475. And then my growth plays are going to be at 300. So the point is to get all to those that level, but I also want to keep my cash at 9%. So it is under 9% at the moment. When I have enough money coming in, of course, and I put in $50 every single week, all the money I make from YouTube goes into this. All the money I make from Beachbody goes into this. For those of you guys who don't know, I am a Beachbody coach. They're switching over from an MLM to affiliate. So because Oracle Investments is all about investing in everything in life, including your health and fitness, because you can't enjoy your wealth without that. I don't talk about it on here because the algorithm doesn't like when I mix things up like that. But if you guys are interested in things, taking care of your health for the long term so you can enjoy your wealth, I am a Beachbody affiliate. That affiliate link actually comes out in November, so I'll share it with you guys at that point. But anyway, I digress. All the money I get from Beachbody also goes into this. Money from Patreon goes into this. So all that extra money on the side will go into my portfolio. And then, of course, all of my dividends. So my dividends here, everything from the green and the dark blue, I do not drip in. I don't put it back into the stock or ETF. I keep that as cash. And all of that over here is $130 this month from the dark blue and $157 from the green. So again, that all goes into my cash. And then as the cash builds up and goes over 9%, that tells me how much money I have to spend. So today I had $45 to spend, and I spent a little bit on Procter & Gamble. I spent a little bit on Flynn. I spent a little bit on Occidental, and I spent a little bit on Microsoft. So still have a little bit left to go, but next week with the money that I have coming in, should be able to top all of this off and get myself to level 10. And that's pretty exciting. And then after that, I'm looking to get myself to level 2 by the end of the year. So I've got full breakdowns on all that other stuff, which I'll show you guys at another time. But I, just kind of how I broke down all the levels, all the phases, what I want to do. And the reason I did it this way is sort of like you have investors that are out there, and you've got institutions who are looking at different levels and they're saying, all right, well, this is overweight, equal weight, underweight. I kind of did it more by the type of stock that I've got. So the growth stocks here, I want to see them long term. I think they're going to be awesome long term, but they don't pay out dividends. But I still want to add to them. So I'm just going to add a little bit lighter because they're a lot more volatile. So Tesla, Amazon, SoFi, Palantir, crypto coins, Bitcoin, Ethereum, Doge, and Sheeb, all of those there are just higher growth. So I'm putting smaller dollars into it because I think I'm going to have, between how they swing, opportunities coming here and there. But as my portfolio grows, I will be able to add more to them regardless of whether they swing up or down, just because they're going to be at a certain level I need to add to. These are all my dividend growth stocks. And these here I'm adding a little bit more to because I want to be able to compound all of the dividends over time and take advantage of the dividend growth in all of these. And I do have over here dividend growth. So 7%, 4.7%. And if you guys didn't watch the video I made last night or 2 nights ago about my top 5 dividend growth stocks, I talk about how thinking about your job itself, and in your job, what do you normally get for a raise? Typically a very good employee is going to get between 3 and 5%. My good friend just got 4.5% at his job. So if you can bring in money that's more than 3 to 5% in your dividends, then you're doing extremely well, and you're outpacing not only inflation, but you're also going to be outpacing what your actual job would be giving you. And sure, when you start off, it's going to be small dollars. It's not going to make a big difference. It's not going to be paying off your mortgage or anything like that in the beginning. But this over time, continuing up over and over, will end up surpassing what your job is giving you. You're going to get more money from your dividends than you will from your job as an annual raise. And this is what I look at. So looking at down here, you get some big monsters. Oracle at 25%, although that one is on my chopping block. But Broadcom, 17%. American Express, 16%. You've got Occidental at 22%. JP Morgan was actually 20% as well. It only shows, I only put it down here as 8.7, but it went up on their dividends twice this year, which is about 20%. All these down here are in the teens. So the yield itself is low, but you're going to get massive equity appreciation from the stock itself, and you're going to get massive growth in your dividends. So the reason the yield stays low on a lot of these is because the equity appreciation is so high and so fast. So the dividend yield is never going to catch up to it, but the growth on it is going to be there. So between those two, I'm not even concerned about the yield. Who cares about the yield when you're going to keep on giving me 25, 10 to 25% raises every single year on these stocks, and you're going to give me an appreciation of, in the range of maybe 30 to 50% on some of these over the last year, which is nuts. But even in a good year, you're going to get 15 to 20%. So if you're going to get that in your stock and you're going to get that in your dividend growth at the same time, yield means nothing. You just hold on to these things long term, you'll be perfectly fine. Then these are the ETFs that I've got, and the ETFs that I have here are, again, longer term. They're not really here for the dividend. Some of them have decent dividend growth in them, and the yield is pretty decent. But these are going to be those stable, steady, long-term things to hold, and at the same time, they're also going to be giving you that stability, especially in diversity, when you get into downtimes. If you're in a downward market, these here are going to give you that stability and diversity to make sure that your portfolio doesn't entirely collapse. And I just realized that I forgot to update my SCHD because SCHD just split recently, if you guys didn't know. So I needed to split my my cost basis on this. So that means it's going to be $25.01. Boom. That's all updated, and I got to update that. So that's going to be, oh man, I'll have to do the math later on that. It's going to be 25 and change. Just do 25.50 for right now. I'm not concerned about my 2024 return. I'm concerned about my all-time return. And my all-time return on SCHD is 18.8%. So then all of these here are going to be kind of stable. Most of these pay dividends that mostly stay the same. Some vary a little bit, but they do grow, some of them. But again, they're higher yields. And because they're higher yields, they give me a lot more income, which is why I don't drip them, because they're a little more volatile, but I'll take that cash instead, and I put that cash into all of the other plays that I want. And again, sometimes it is these. So if I'm at a point where my portfolio is telling me to add to these are top. I add top to bottom. So top to bottom I add because I'm going to be generating more cash with these. And eventually I'll slow down the adding to these, and I'll be adding more heavily to these down here. But this here will be generating so much money, it'll speed up the progress on these. It's kind of that my own personal snowball type portfolio. And so for me, that's it. And again, anybody who's a member and patron, and thank you, Gormless Twit, for signing back up as a member. I was kind of off the radar for almost a year there. So thank you guys who stuck around with me. I truly appreciate that. Now I'm back up. So anybody who's a member and patron, you have full access to this. All you have to do is, in the comments, just let me know your email within the member and patron area, Patreon area. And I'll give you guys, you just have to give me your email so I can give you guys access to it. Beginning in November, I am also going to be looking, and I'm going to do the logistics this weekend and next weekend. I'm going to be opening up about 4 hours a week. It'll be 2 hours on Saturday and 2 hours on Sunday. I'm going to play around that just to kind of see what other people's availability is, what I can do and not burn myself out, and do it for financial coaching, for health and fitness coaching, kind of life coaching. It's what I'm going to be getting into over the long term to kind of help myself build up a business to be able to transition away from my full-time job and do what I truly love doing, which is helping you guys out. And so I'm going to be doing a lot of that coaching and a lot of the financial coaching. And I'm not a financial advisor. I will be getting a coaching certificate, but it's like I've gone from $75,000 in debt to now I'm at a $200,000 net worth, and I did it in 7 years. And again, there's a lot of different factors that are involved. I'm not saying that you guys can do that. Some may be able to do better than me. Some may not be able to do as well. Again, a lot of different factors, but I've been through it, and I want to be able to share the wisdom that I gained over that time and show you guys what I did for myself to help others do the same thing. If you're in a position where you're like, man, I want to invest, I feel like I'm kind of stuck and trapped at my job and I'm never going to be able to get out of this. How can I get myself out of this if, I'm not getting a big enough raise at my job to overcome any inflation or my expenses going up? And I just feel like I'm falling more and more behind every single year. I was going through that. I want to be able to share with you guys what I did to be able to help you as well. And so I'm going to start off with the first half hour is going to be a totally free session, and the information I'm going to be 100% open. I'm not going to be like throwing a pitch at people in this half an hour. It's like hey, tell me what's going on with you, and I'll give you as much advice as I can in that half an hour. And if it's enough in that half an hour for free, awesome, take it and run with it. I'm not here to take your money. I'm here to help you build your wealth up and get yourself out of debt and do whatever you need to do. And then if you want some accounting afterward, accountability afterwards, just like health and fitness, I would do the same. If you want that accountability on a monthly or a quarterly basis, we'll work out some sessions. And from what I've seen from pricing, what I came up with pricing is so much lower than everybody else. It's like literally what's going to help me just pay the bills, and that's it. So my pricing is super low, and I'll share that with you guys once I finalize it all as well. And again, that'll be up to you if you want to do that for a coaching piece in the future. But and again, on these live streams here, you guys are more than welcome to ask in the comments anything you want. I'm an open book. I'm willing to share all of this information totally for free. I'm going to start making some videos on that. I did some in the past. If you guys want to check the archives from when this channel was super raw, back in my old apartment, looking at just how I did the videos, I shared a lot of that in there of what I did to get myself out of debt. It was literally pen and paper, writing down, tracking every single penny coming in, every single penny going out. I was writing down all of the debts that I had, tracking every single week when I got my paycheck. What am I paying off here? What am I paying off there? What is the lineup that's going? I put a lot of time and effort into it. And if you want to succeed, you've got to put that time and effort into it. But I promise you it's worth it, because at the end of the day, once it's all done, it's kind of like a set it and forget it. You've got a routine and set on that, just like working out. If you make it part of your routine, and I've heard this before with working out, if you consider it like part of your hygiene, you will just do it naturally. And that's what I do. And every single morning I wake up and it's like part of my hygiene. I wake up, I work out, I take my shower, and I go to work and get on with my day. And if you consider working out and taking care of your health, like brushing your teeth and showering, you're going to find a lot more success in it. And you're not looking at it as, a drudge of like, oh, I need to go and do this. And you're not going to look at it as I feel great. And if you feel great about it, that's awesome. But I've also learned about the whole feeling great about it thing is when you have to take a rest day, you don't want to. And it's important to take rest days, because then you'll overtrain and you won't be able to get back to it. And then you fall off the wagon. So again, it's great to have that euphoric high from working out, but you want to make sure that you just make it part of your routine, just like eating nutrition properly. You just want to eat the right things. I eat it for fuel. And yeah, if I want to have some cookies, like I've been the last few weekends buying some cookies, probably shouldn't be buying cookies, but whatever. I've been in the mood to buy and eat cookies, so I've been doing that. And this weekend, I'm not going to, just because we have an event going on at work tomorrow, and I'm going to have some food there. I'm going to get home and I'm just going to do my normal thing. But hey, who knows? Maybe I'll be tired tomorrow after work and I'll buy some cookies anyway. But I'm not going to beat myself up over it. I wanted cookies, I'm going to eat them. But because I keep my routine Monday through Friday eating properly, and I do it mostly good on the weekends, doing a little bit like that, enjoy life, whatever, it's no big deal. But it's all about having those routines, just making it part of your normal, natural life, and not making it as I have to do this. It's an obligation that I have to do. Nah, it's just normal and normal part of your daily routine. And then when it comes to your wealth, the same thing. You just make it part of your routine. And then once I paid off all of my debt, I got to tell you, man, especially with high yield interest, all that money I now was putting towards my debt, it was going into savings or investing. God, my portfolio blew up. My savings blew up. Then I moved over to SoFi. And if you guys don't have SoFi or something like it, and again, I've got it in the link down below in the description. You guys can sign up. There's savings. You could do investing through there. There's a couple of different links in there for you guys. But once I moved a lot of my money into SoFi, it was a game changer, because first off, high yield savings going from a like 0.01% interest at my bank here locally to a 4.6%. It's down to 4.3% now. Getting that, I'm pulling in like $30 to $40 every single month in interest alone, just from having my money in SoFi. Ridiculous. But it also breaks down the vaults. And what's so important about the vaults is every time I get direct deposit from my job or from YouTube or from Beachbody, whatever it is, it goes into there, and then it breaks it down into my vaults. And I won't share here just because I don't have any way of blacking out my account information. But like I've got vaults for my emergency fund, obviously number one that's on the list. I've got vaults for my son's college. I have vaults for a new car because my car has 200,000 miles on it. Probably going to need to get a new one soon. So I want to make sure that I have money saved up to at least put a down payment, if not pay for the whole thing. I've got a vault for my stock portfolio. One thing I don't like about SoFi is my uninvested cash in my portfolio itself does not accrue the percent interest, doesn't do the 4.3%. I have to have it in my savings. It's fine because I can easily transfer it right over and it's an instant transfer, but it's one extra step. Maybe I'm lazy, whatever. I wish it was directly right there and anything that was uninvested. I've asked SoFi about it. They haven't answered. So either way, I wish SoFi would do that. And if anybody from SoFi is watching this, please change that over. But I've got vaults for a refinance on this house because I got it at 6.5% interest. Interest rates are coming down. If I see something under 5, I want to have money put aside to be able to reinvest, to refinance. I've got money getting put aside for a second house because I do plan on investing more into real estate. And I've got a vault for travel because man, one of the things I would beat myself up better is like I want to go out and enjoy life as well. I don't want to just work constantly and just put money into savings and investments. I'm doing this to enjoy life, but I always felt guilty about taking money out of my savings to go and travel. So I'm like, well, what if I put money aside on a regular basis? And then I was like, hey, now I've got a couple $1,000s in my travel fund. Cool. Now I'm going to go on a vacation. And that's what I've been doing. So I put the vault there. But with all of these vaults, every single direct deposit that comes in, I have a certain amount getting put into each one of those. Like, for instance, the mortgage and the windows that I got on the house, I have enough money coming out every single paycheck to go in there. At the end of the month, that money goes into my savings account because it comes out of the vault, goes into savings, and then the account that I have it tied up with for the loaner, the money just goes right to the loan. And that's it. I set it and forget it. I don't even have to touch any of it. I just have to monitor, make sure, yep, that direct deposit went in. With my job right now, because I get commissions and I get overtime or I work in a different location, sometimes they send in 2 direct deposits. So because of that, it's not SoFi's fault, it's my job. But because I get 2 different direct deposits, it'll double direct deposit everything in. So I've got to back some of them out. Emergency fund, I'll let it grow because I'd rather have the extra money there. But everything else, I got to back out of it. But otherwise, everything is hands off, smooth, seamless, comes right in, goes into my vaults. All the things that have to get paid come immediately out, get paid automatically. I don't even have to worry about it, and it's all gone. And on top of it, the money I'm putting aside for my son's college and my mortgage. The mortgage was the big one for me. The money that I'm having put aside for my mortgage is collecting interest on a monthly basis. So I'm getting about $10 every single month just from having my money from my mortgage in that vault. And then so I get $10, pay off my mortgage. Now I've got 10 extra dollars in that vault. So then over time, I'm just going to have more and more money in that vault that I can maybe make a mortgage payment with or something in the future. But either way, my money that I'm using to pay for my mortgage is making me money. And then my son's college, which, I have to save up about $7,000 a semester. As that's building up, all of that money is also going to be accruing interest, which will pay off that college even faster. It's amazing. So if you guys don't have any extra savings on the side in a high yield savings and you have in a regular savings, I strongly recommend finding a high yield savings. Again, I love SoFi, but if you guys can find another one that you like in your area, that's awesome. Chicago is watching. What's going on? Thanks for tuning in. I appreciate it. I don't know what the weather's like there, but I know the weather here has been unseasonably cold, but it's supposed to be relatively nice over the next week. So lows had been dipping into the 30s. I normally wouldn't turn my heat on, but I have a tenant now, and I want to make sure that my tenant is taken care of. And because of the way the house is set up, it's only on one boiler. So I was like, you know what? I'll let her keep the heat on. That's perfectly fine. I'll keep mine a little bit lower where I stay, and it's fine. And it'll give me a good sense of when I do end up just having a rent for someone where I include the heat. I'll at least know what the expenses are going to be for that, so I can budget that in. And that's another huge piece too, is budgeting. So I am working on, and this is probably currently a pipe dream, creating an app. And I want to do an Oracle. It's going to be Australia in the house. What is going on, Edwin? Oh man, I got to get back to Australia. Absolutely loved it there when I went there for a few weeks. So the budgeting is so important. So I want to create this app, and it's going to be like an Oracle life tracker, and it's going to be for literally everything. It's like, there's a lot of apps that are out there like Acorn and things like that that are going to track your finances and your budgeting, and it'll be able to take all of your credit cards and bank and everything and put all your expenses into one area. Awesome. I love something like that. I do that for myself with my spreadsheet. Then you've got apps and things that are going to be able to track all of your portfolio and all of your stocks and things like that. Whether it's your broker or another one that puts everything together, there's apps for that. There's going to be apps that are out there that are going to be able to help you track your nutrition. There's going to be apps that are going to help you track your weights for your workouts. I want an app that's going to do it all. And I want in this app for you to be able to go in there and type in, hey, I just created a manifest list through 28, 28, and 2030. I want you to be able to go in and say, these are my plans for the next 5 and 10 years. You're going to have those all set. Then you're going to be able to create your own profit and loss statement like I have done for myself. You create your own profit and loss statement. You're like, here's my budget for the next year. This is what I plan on doing. I'm now going to track that. So then as you're spending your money, as you're investing, as everything is just happening naturally, it's all going to funnel into this app. And once it funnels into that app, it'll distribute into all the different categories and areas that you have already preset. And it'll show you where you're going and how you're doing versus your P&L and your budget. It'll show you how you're doing for everything else. Then again, you're tracking your weight, you're tracking your health and fitness. That tracker will all be in there. It's like a one app for everything is what I want to create. And I know it's going to be very cumbersome. It's going to be very labor intensive. That's what I'm looking at trying to do over a while. So I've got a buddy of mine who does them. So I'm trying to get that built up. But if you guys are interested, my spreadsheet that I have is pretty much doing all of that, other than the health and fitness stuff. You guys can see it. You guys can see what's going to be the very foundation and groundwork behind what I'm planning on doing in the future. And that is one of the reasons I've been as successful as I am. All of these progressive steps that I've made in tracking and coming up with the plans and budgeting and just having all of this put together has made a huge difference. Oh, hey, Lang. Oh, hey, nice new name. All right. I don't understand why you have so many dividend stocks. So for me, Edwin, that's a good question. Bringing up, the fact that I have so many, and I know that I'm over diversified. I know that I have more than I need right now, and I have thinned this out by about 20% already. So the reason I have as many as I do is because I still do think that early first half of next year, we could get into some rough times. And when you go into some rough times, you want to be more diversified than not. And that's part of the reason why I have as many as I do. And what's going to end up happening with this portfolio is as we go over time, and if we don't go into a recession and we have clear sailing signs ahead, I will consolidate a bunch of these. If we do get into a recession, once we get to the bottom of that and we start to see the signs of coming out, I will see who the winners are of all of these, and I will start adding more heavily into those, and then I'll consolidate from there. So that's the reason why I have as many as I do right now. Now, this gray area here is all stuff that I've already sold out. So as I said, I've already thinned out a lot of my positions. So all of the stuff in the gray here, I've already sold. This is all gone. And this is what I have left. So as time goes on, I will consolidate more. I'll pick some winners. So for instance, like when it comes to REITs, I've got Vici, I've got Realty Income, I've got Prologis. So between these three here, I may keep them all. But maybe I only need 2 of the 3. Let's see what's going on. Realty Income, steady Eddie, always been consistent and great. I think they have a wonderful portfolio, but they do have a couple of companies that are maybe questionable. Although Walgreens did have a great, wonderful beat on their earnings, they've been destroyed over the last 5+ years. So, it's one of those things where, I'll pay attention to Realty Income, make sure they're making the right moves to can keep themselves moving forward. BDCs, I have Maine, I have ARCC, and I have HTGC. So maybe one of those 3 I end up dropping, and I consolidate it down to 2. TLTW is a bond one, so I'm keeping that one in there because that's kind of different. I've got SVOL, which is volatility. That's kind of a unicorn type play, although I'm paying attention because it's been not performing as well lately. So I just want to just keep an eye on that one. Then I have a bunch of different covered call type ETFs. And those are the ones I'll probably consolidate. Like QQQI and SPYI pay a higher yield, but they pay consistent monthly dividends. It doesn't change. But like a JEPQ will appreciate in equity better than these two. So when I'm looking at that, it's like, I like that one. But again, there may be ones that just emerge better than others. And I'm just kind of waiting for that time to be like, all right, well, these are going to perform better. And I'll kind of just say, hey, maybe JEPQ isn't performing as well as QQQI. Cool. Pull it out of here, put all the money into other places and spread it out. But that's why I'm diversified as much as I am, just because I'm just waiting to make sure that we're in healthier ground before I consolidate. Let me see. I have Tesla. What's your view on Tesla and NVIDIA or those of the same kind? So in here on my portfolio, I do have Coney. Up at top here, I've got Coney. And the Yield Max ETFs, man, it's high risk, high reward. But the problem is they have such awful NAV erosion that holding them long term is really just going to deplete your account. So I had Tesla, and as you can see down here, get to it. So I had Tesla and I ended up selling out of it. And my overall return, I think it's still up on here. So despite the fact that with my, you can see all the way at the end here, I brought in over $1,000 in dividends with it last year and $300 with it this year. $1,328 in dividends. But because there was so much NAV erosion, I actually ended up upside down $410. So the income is awesome, but is it really worth it in the long run? So I learned my lesson with Tesla, and with Coney, I ended up buying it and it did great. So a lot of times these high yield ETFs are going to, like if they're new, like PLTY just came out for Palantir. A lot of them are kind of like, what's the hot one right now? And people buy into it because it's hot right now, and then they start to sell out. The problem is, especially with Tesla, a lot of people start shorting them because of the NAV erosion. They're like, it's almost guaranteed money to short these high yield income ETFs because they're going to make so much money because the NAV erosion automatically brings them down. And if they short it, it's going to bring it down even more. So detrimental to the ETF and to your own overall returns in the end. Now, if you can catch it, because sometimes it swings. So Tesla's never going to be able to return and come back up and appreciate as much as Tesla stock itself. So if Tesla goes up 10%, you're not going to get that 10% out of Tesla. You're going to underperform with maybe a 3 to 5%. So the income that you get in is also not going to make up for that loss of that income. But if you catch Tesla at a time where Tesla itself is beaten down and you buy Tesla low, you'll get that little bit of appreciation coming up and the income. If it's growing slowly over time, that's great because you're going to be getting that little bit of appreciation and the income. And if you're in it for the income only, you're going to do perfectly fine on those. But if you're going to be in it for a long-term overall return, you might as well put your money into Tesla stock instead. So the reason I have Coney is because I don't invest in Coinbase, but because of the cryptocurrency and how that's been fluctuating, I did very well on Coney. I have made enough money on Coney to cover the entire cost that I spent in there and then some. So I'm basically playing with the house's money right now. And so I take all that income that I have coming in and put it into other plays. So I'm just using it kind of like as a free ATM almost for what I've got going on with Coney. And if you have an opportunity with any one of those other high yield ETFs from Yield Max or any of the other plays that are out there, that's a strategy you can use. But you have to just really make sure that you're paying attention to NAV erosion and paying attention to what is the underlying equity for that going to do, because you're most likely going to underperform. But if you think that that underlying equity is going to perform well and you're in it for the income, could be worth putting your toes in the water on that. Now, what I did do on it was I did get YMAX, and YMAX is all of the Yield Max ETFs kind of lumped into one. The reason I did that is because some do perform well, some perform poorly. So it kind of keeps the NAV erosion at bay, and they do pay weekly now. So, the weekly income isn't awesome, but overall it's still nice to get paid on a weekly basis, which, oh, here it is. So still bringing me in almost $40 a month. So almost $10 a week that I'm bringing in from YMAX. And they just started doing this at the beginning of the month. So I'm going to kind of monitor this over time. But for me, it's not terrible, and my overall return isn't super awesome on it. I'm 11%, still outperforming most average market years. But I'm in it for the income, and that is just feeding my other plays that are out there. Um, but that would be why. Um, you're very welcome. Poor bold. Why stock quantities show with fraction? Because I do buy fractional shares, and um, and then because I was dripping these at first, but I buy fractional shares, and then down here, anything that does drip in ends up creating a fractional share. So, for instance, like I'm only bringing in $2 a month, but it pays out quarterly. So if I'm bringing in $6 from UPS, it doesn't buy me a full share; it just buys a fraction of a share. So this shows the true amount of what my portfolio is. So that's why it's fractional shares. And now I do know that some of you are from around the world and you don't have access to purchasing fractional shares. But I am curious, and I don't know this, and you guys can let me know from around the world if you can't buy fractional shares. If you're getting dividends on your stocks that you own, that does go into fractions, right? Just making sure that you can buy those in fractional shares, or at least it converts it into fractions. Because I know through Schwab, who I have, I cannot purchase in fractions, but when I get the dividends, it obviously is going to give me that dividend in a fraction. But I'm curious as to if it does the same thing from around the world with you guys, because I obviously don't know, and I'm really curious on that one. No problem, Lang. Yeah, that's yeah, and the reason then that's why I went to YMAX, and YMAG is another one that pays it on a weekly basis, and YMAG does the Magnificent Seven stocks that they have in there. So, you can take a look at them all, but I always take a look at the NAV erosion, because that there itself is going to tell me how quickly my funds are going to deplete. And then if I do think that we're going to be going into a potential recession, probably don't want to own any of them, because you're going to get hit with 100% of the downside of all of those stocks. And yes, you're going to get that income coming in, but the yield stays high. So let's say you're going to get a 60% yield on a Tesla. That's awesome, unbelievable. But 60% on $15 and 16% on $10 is significantly different. So just because you're paying a 60% yield doesn't mean you're paying the same amount every single month when it pays out. It's depleting every single time that NAV erosion occurs. And if you don't never get to recover back up to that, then you're actually making less and less over time. Let's see. Anything else we want to go over? You guys have been awesome tonight again, as always. Love it. Love you guys on here. I may, and I've just got to take a look and see how I'm feeling. The last 2 weeks for me with work, I've worked 6 days. I worked 6 days last week, and I'm working again tomorrow, so another 6 days this week. I'm a bit burned out. I was contemplating switching over to Thursday evenings for live streams, because coming home on a Friday might just need to decompress, might be able to do a video and edit it on Saturday and put it out, or just not do anything at all to decompress. I love spending time with you guys on a Friday, but I just need to make sure I take care of myself as well. So I'll keep you guys posted if I'm going to do Thursdays or Fridays going forward. But let's see. Yes, net had eroded, even though I do get a highly monthly yield. Yeah, and that was the thing. And Tesla already did a reverse split, and reverse splits, regardless of what they are usually death signs for these things. So I've got, for instance, on mine. Oh, sorry, hit the wrong button. So QQQI and WDTE did a reverse split as well, and they're paying weekly. Again, I'm writing those out just because my total return on those, 48.5% and 36.5%, they've paid out very well for me. Like Coney at 200%. I love Coney. I did so well on that one. Very, very happy with it. Look, I made 200 or $2,000 on it. But these here, because they paid out so much, I'll pay attention. If it continues to drop down and my all-time return is shrinking, 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 that's how I'm going to tell that NAV erosion is really taking over. So they did make some adjustments to the way they perform when they did the reverse split as well. So I'm just paying attention to see if the adjustments they made are going to offset that NAV erosion and keep them trading steadily. If not, I'll dump them. And again, I like the income coming in from them, but if my overall return is going to be losing me money, the income I make every month means absolutely nothing. And yeah, when I was seeing the TSLA NAV erosion going on, I heard so many people talking about it, and I'm like, it's like let me pay attention. And I was up doing really well on it, and then theoretically, if it wasn't eroding as quickly as it was, I could have held on, and eventually the income I made from it would have offset any of the NAV erosion that I had. But it was eroding so fast, I couldn't keep up with it, and it just wasn't worth it, and so I dumped it. Um, but I did take that. So while I did end up with a $400 loss on it once I sold it, I did take that $1,300 I made and put it into all my other plays. So it wasn't a total loss because that $1,300 helped me make significantly more money in other areas. So if I could probably do the math on it and figure it out, and I probably more than made up for that $400 loss in doing that. And that's one of the things that my dad taught me as well is sometimes taking a loss on something to put that money elsewhere is way better than just waiting for it to potentially turn around. Even if it's a good company that is going to turn around, putting that money into something that is doing well right now will often help you even more in the long run because you're going to be able to recoup that money faster than waiting because you don't know when that other one is going to turn around. Sure, maybe it happens tomorrow and oh well, it happens. But sometimes, I mean, look at Tesla. It's been basically sideways for the last 2.5 years. So if you were waiting for that to turn around, could have been 2.5 years. And that's why I ended up selling a good chunk of mine because I have made significantly more money with that money than I did if I was holding on to it. And that's why I made that decision. And so I take my dad's wisdom that he has shared with me and I used it myself and I share it with you guys is sometimes just knowing to cut your loss. And this is why a lot of people out there in institutions do tax loss harvesting. They see that they've got a loser, they've got to offset some of their gains. They can then take that money that they've lost and offset those gains for tax purposes and put that money into something else that will make them more money as well. And that's just how the game is played with swing trading. And even with long-term investing like I'm doing, sometimes I see things I'm like, you know what? The fundamentals on this company aren't doing as well as I thought. The fundamentals have changed, or my whole thesis has changed on it. Dump out of it. That's what I'm doing with Oracle right now. And so while with Oracle I haven't sold it, I did put in, I sold half of a share and then I put in a stop loss because it was performing well. And it did dip down and almost triggered off. I was about $3 away from my loss trigger, but then it bounced back up. And they've got earnings coming up in November. So if we get through the election without pulling down and triggering this, perhaps their earnings do well and they jump up again. They jumped up significantly over the last two earnings. Maybe they do it a third time and we push up to that $200 mark, and that will increase the amount that my stop loss will trigger at for my sale. And then I'll make even more money on it. Let me see. Poor Bold, you can create another video focusing on NVIDIA and ARM stocks, highlighting the fluctuations in their charts and explaining strategies for short selling. I would. I don't know. Like, I'm not a short seller. The closest I'm ever going to get for short selling for me is going to be if I'm going to be doing like options, and I'm going to be learning about options over this winter because my portfolio is getting to the size where I can actually start playing options, and it would be playing puts. And the reason I would do that is because right now, just like I do selling with a stop loss, I do pick up like triggers, and I say, hey, this is a level I would love to buy this stock at. And if I can play options that way, you play options with a put, and you're saying, oh, I like it at this level. Now I'm going to play an option on that. I'm going to make some options premium on it. And if it gets down to that level, you buy it at that level anyway. So it's basically doing what I was already doing, but I'm going to get paid a premium for it. And again, the only risk about that is if it never triggers at that level and it takes off, you miss the upside on it. But for me, the way I'm playing my portfolio, it doesn't matter because the options premium I'm getting is really what I'm going after. Is sort of like a dividend. I'm just going after the premium. But that to me is really what I'm going to be doing when it comes to shorting. So I mean, I could probably talk about it. I know enough about short selling, but I don't know the strategies behind it and how people do it because it's not something I prefer to do. I like to buy. I don't like to short sell. Short selling to me in many facets is kind of like dirty because you're basically, especially the way hedge funds do it is dirty because they're finding a company and they're saying this company is no good anymore and we're going to accelerate the company going bankrupt and just bury it into the ground by short selling it. I don't like that notion. I'm more of a positive type person, and to me short selling is on the negative side. But I could talk about Nvidia for sure, and the fact that there's a lot of people who think that, some people think that we're in an AI bubble, some think that we're not, and thinking that we're in an AI bubble is potentially out there. I was hearing this morning about a lot of people who are out there, and there's a lot of companies who basically don't even have a business model, and they're getting funding for hundreds of millions of dollars. So that reminded me a lot of the dot com bubble. And the dot com bubble was there was a lot of shell corporations that were out there just because they had dot com on the end of their name, and they were making, bringing in hundreds of millions of dollars just because they had a dot com on their name, and they literally had an empty office with a phone in it, if anything. And I'm not saying that these AI companies are like that, but it gives me the same feel. And I'm just wondering if we're going to get to a point where we hit that place where all of those companies get wiped out and there's a huge drop in the market because a lot of that money gets pulled out. Um, so so I can certainly talk about that. I mean, I don't know if I will make a full video on it. I kind of explained as much as I know right now on it. Um, but I think Nvidia is eventually going to hit a wall, just like any company would. I think it's going to be perfectly fine long term. But I think the euphoria behind Nvidia right now is eventually going to hit a wall because we're going to hit sort of like Apple and the iPhone, where the excitement hits there and eventually hit that point where, all right, now everybody has the phone. The phone is good for 3 or 4 years for the most part for most people, and they don't need to upgrade every single year. And just like with the chips that Nvidia has, the Blackwell's coming out now, eventually you're going to get to a point with the Nvidia chips where people and these companies aren't going to have to upgrade every single year. And you're going to, once we get that full rush and everybody has a chip of some sort, then you're going to get to the point where, all right, everybody already has what they need. Then we're just going to get into, now we have to wait on the waves of, all right, where are these cycles and the super cycles coming in? So like the Apple iPhone super cycle is, well, that first massive wave of people coming into the smartphone and iPhone there, those are the people who, every like 3-4 years are cycling over into a new iPhone. We see the same thing with the Nvidia chips is all those chips in the beginning, all that massive first wave of people coming in, eventually we'll need to upgrade. And then you'll see, every 3 to 4 years that cycle coming back over. And I think eventually we'll hit that. And once we hit that point, you're going to see revenues level off and the growth percentage kind of come down significantly because you're not going to see that same growth. And it'll be steady. It'll be a nice steady growth. And that it was at that point basically where Warren Buffett bought into Apple because it was a nice kind of value type play, steady growth that you can track regularly every single year. And it was easier to follow. And you weren't trying to chase big numbers. Once NVIDIA gets to that point, I think we're going to be in the same place. And quite honestly, NVIDIA is one of my kind of closet secret top picks for dividend growth because they grew 150% this year. And eventually we're going to get to the point where, that's going to come down as well, but they'll probably do a 20% year over year dividend growth on it. And you'll still get some steady appreciation. It's going to be very much like an Apple stock, I think. And it's just going to take, 5-10 years to get there, but we'll see appreciation like Apple did. So I think NVIDIA could play out a lot like Apple in the long run. And it's going to be great, but in the near term could see some uncertainty for sure. Yes, your dad advice is really great. Thank you. Appreciate that. I was locked in that Tesla for, Tesla for the past almost 2 years. And again, I think Tesla is going to be awesome long term. I think 5-10 years down the road, especially when robotaxis hit and we actually get to see revenue generation coming out of robotaxis, I think Tesla's going to be awesome. I think the stock is going to be amazing. I think it's going to be one of the best plays you can have over the next 10, 15, 20 years. But in the next 5 years, we might see some uncertainty. We've got earnings coming up next week, so I will be coming on to do a video to recap that. I won't be home in time to do the live stream, but I'll do a recap of it all for you guys that night. But again, they finally are showing better signs of deliveries coming out, but they're still taking big hits because they've got to pay for all of these financing options that they're giving to people. So I'm curious what margins are going to look like. I don't think they're going to look awesome. I think we've bottomed, but I don't think margins are going to be anything to write home about. We're not going to see most likely a year-over-year growth when it comes to deliveries. And if we do, it's going to be a very small percentage. It's not going to be like a 30%. You're going to see like maybe a 1 or 2%, if that. So the numbers fundamentally for Tesla are stale at the moment. I think they're going to be fine. I think, as we get the compact car coming out next year, we're going to see those numbers really jump back up again, but it'll take a while for that stock price to really reflect that. My personal opinion, could be entirely wrong, but I think it's going to take some time for that to actually be reflected. And if we're going to be getting into a potential recession next year, all bets are off. We could go from the price we're at right now at 220 and drop down to 110. We could easily see a 50% drop, maybe test $100 again, depending on how bad a recession is. Just things to pay attention to. So glad that I DCA into Palantir, NVIDIA, Apple, Google, another Mag 7, so I'm in positive gains. Me too. That's actually part of, just like I put money from SoFi into my vaults, the way my portfolio is set up is exactly the same way. And as I showed you guys before, I have money that gets put into there. So once I hit phase 10, level 10, these here, I'm going to be jumping up. So I'm going to be adding money to Amazon. And as it swings, and because it's awesome, because these do swing a lot, when I see quick dips on these, I'll be able to see, oh, I need to add $5 or $10 here, and I can grab a quick dip with any extra cash that I have. This plays out so perfectly for me because I can see that. And it's basically my way of dollar cost averaging. And instead of just doing a dollar cost averaging like you would see from like a 401k where your money goes in and just automatically gets distributed regardless of what price you're at, when I have the money to be able to dollar cost average, I can see, all right, well, what ETFs and stocks do I have that are the most beaten down right now? And I'll be able to get a better bang out of my buck. So it's not like I'm buying, I'm not timing it to buy at the bottom, but I'm definitely buying the stocks and things that aren't hot. Like buying, something that's very frothy, I may not want to do with a dollar cost average. But if I see something that's like, hey, people are not liking this one, it's kind of fallen out of favor, but I know it's going to come back, my portfolio will show me that it's out of favor, and I can add to that one rather than adding to something that maybe is going to be cooling off and I'm now buying at a higher price rather than buying at a lower price. So my portfolio helps me buy low and, hold high because I don't really sell much. All right. Well, that's about all I've got for you guys today. Wow, 52 minutes. This has been an awesome live stream. Thank you guys. I love the conversations with all of you. But I'm going to duck off because I do have to work in the morning. So thank you guys all so much for being here. Love the conversations we have. Love you guys for being on, and thank you guys so much. And I've seen many of you share my videos. Absolutely love that. That helps get that the viewership out there, helps the algorithm, helps the channel grow again. And this whole transition over to dividends from specifically just Tesla and doing more all-encompassing investing has been nice. And thank you guys in helping that transition. So I hope you guys have a great one. Thank you so much. And we'll see you in the next one.